Hello, this is the Chart Profit video. Friday 13th of January 2017. We are less than an hour into the trading day. This is the pre-open today. We're looking at the E-mini S&P. Mention first of all that the first level support, the 4-month point of control, had migrated slightly higher to 2263, which is this level here, and I've said that price relative to this level is now important to monitor, so I've marked that on the charts. So this is a live 5-minute chart of the E-mini. When I released the pre-open about 2 hours pre-open today, we were up here. Here's 2263, support I mentioned, and you can see that we just probed into that level exactly, and we've rallied a lot higher, and that's a good reaction off a migrated point of control. So as long as the E-mini holds above that level, as I said pre-open, we're in a strong price location here. So that's our first level support, 2263. Also mentioned that the price oscillator momentum on the spider chart just ticked back very slightly into positive, but remains negative on the Russell 2000 chart. And you can see that here on the pulse chart down here. We had dipped into negative territory just a little over the last few days, but we're just back into positive territory there, with the breadth indicators remaining positive as well here. Now, a big positive would be significant buying marked on the profile, and that would give us a green bar like this one here, and that would be an indication that large significant buying is taking place in situation with supporting technicals like these. As long as this price oscillator at the bottom here can now carry on higher and remain above zero, we've got trend up from this indicator. Let's look at the support on the other charts. On the spider chart here at 2216, that's the 2-month point of control, and you see the spider holding above that level. Key level is the Russell 2000 ETF, IWM, the key level being 136.70, which is the 2-month. We haven't yet got above that resistance convincingly. We've been printing below that level all week. We'd much rather see IWM printing above here. If that's the case, we saw a couple of days of that next week, we'll probably see a breakout to a new high, but I definitely want to see that resistance overcome. So this one, 136.70, the 2-month on IWM, is a key level, as is this level on the diamonds, the Dow Jones ETF. 3-month comes in at 198.90. The other stock index we follow is the Qs, Nasdaq 100 ETF. We can see that today is finishing the week really strong here, new high currently. Just a reminder, this is recorded early in the session on Friday. Similar looking chart is XLK, the technology sector ETF, and you can see the major support here on the major support, but the most local support, the 2-month at 48.96. We just approached it this week. We've held on, we're out at a new high. Price back below that level would put the chart in a weaker price location. Currently it looks very healthy. Okay, in the pre-open today we talked about the sentiment here, specifically the RightX Ratio, slightly higher on Thursday at 7.74. I've noted here that Monday's ratio at 6.26 was an 18-day low. We'll look at the chart in a second. But I've said here the ratio has fallen a lot since it reached 11.83 on the 3rd of January. That was the highest ratio since June 2015. There we are on the chart. That was that high level above 11, being the highest since back over here somewhere, June 2015. So we've seen that kind of surge in bullish optimism here in mid-December up to that level. But unusually, without the market selling off from there, the RightX ratio has fallen quite swiftly, indicating to me that something is worrying the retail trader. I'm guessing it's the inauguration next week, but there's some fear has crept back in pretty quickly into the market without the market itself, without price coming off. That's reasonably unusual, and in the short term could actually help the market higher. i.e. we've just put some fuel back into the market here. So you can see it here reflected in the rise in bear fund assets there. off a very low base, I'll hasten to add, and a really quick, swift decline in bull fund assets. You see, previously, yes, that will happen, but usually in an environment where the market is selling off, not just kind of, well, actually rallying at this point. Looking here at the public poll from AAII, the bulls percent was actually lower this week at 43.6. Bears percent was higher, so there's been an increase in net bearishness this week, decrease in bullish optimism. 4-week moving average in black here is getting reasonably high. Doesn't always peak with the market, so I wouldn't exactly call this neutral, but it's not too worrying. The net figure, bulls minus bears, at this point here reached 27.8 7 weeks ago. That was the highest since February 2015. This is the investors' intelligence this week. Bulls percent was lower at 58.6, but that was down from the previous week's 60.2% bulls, which was the highest bulls percentage since July 2014. So that is getting reasonably extreme there. The bears percent this week was almost unchanged, 18.3%. Previous week, 18.4% bears. In the previous week's net position, bulls minus bears at 41.8, and that was the highest since May 2015. That's right here. Look at US fund flows this week. Reported equity funds, including ETF inflows, at 2.4 billion, same as last week, the previous week, and 6 weeks ago the 4-week flow reached 23.36. That was the highest since March 2015. So we kind of peaked about 6 weeks ago on a number of indicators in bullish optimism, and that was at that point there. Since that point the market has rallied, and across that period generally we've seen money flowing out of the market in net terms. So again, possibility there's some fuel here in the tank. Looking here at the commitments of traders data from last week's ebooks. This is a week out of date. This is a longer term indicator. Often takes time for this to play through, but you'll notice on the rally here in the market we've seen the commercials net position heading down, and we've seen the small traders net position heading up. We could see the small traders net position breaking out to a multi-year high if it pushes much higher. That's not encouraging development should that happen. You can see what I've done there with the commercials net position and the price leading into those previous points where the market at least stalled. If I just show the same indicator on the commitments data, the commercials here in black at the top of the indicators here for T-bonds, you can see a very different situation, and I've actually seen something develop in the TLT chart, which we'll talk about now. Okay, here's the T-bond ETF TLT. Previously the major point of control was at 117.15. It's actually been at that level for years. And what we've seen this week is we've seen the major move up to 117.15. Okay, let me run that by you again. The major has moved up from 117.15 to 121.60. It's done that this week. And the major point of control at 117.15, it had been there for years. We had this really good support here. That support in effect has now gone because the point of control has moved higher. That's the way I regard it, and we're currently today printing below that level. So if you are following TLT, you may be looking to get long this ETF. You really want to see TLT now back above 120.160. What's happened by that point of control moving higher, we've suddenly gone from a strong price location here above the point of control. It migrated, we're now in a weak price location below this new point of control. So if bonds are going to extend this rally from the low here, we really need to see it back above 121.60. This is the gold ETF, GLD. We've seen a decent rally from the December low. This level here, which is just below 116, is the halfway point from this important low over here to this high. Personally, I'd be much happier about long gold if we saw time printed above that level. In the longer time frame, this is still weak price location. Been talking about the possibility of this major migrating higher from 1078 on the USO chart, United States Oil Fund ETF. Has not done so yet, so this is still major support down here, and that means that oil up here is still in a strong price location. Looking here at the dollar index chart, this peak over here was the highest multi-year high since April 2003. We've come off that a little bit. Good number of videos ago mentioned a target for the dollar index based on the current major distribution up around this level, so opens the possibility that the dollar index is topping out here. But as I said last week, we'll take the cues from the pairs charts, the pound, the euro. Let's have a look at those. Well, as we mentioned last week, the pound found resistance here right on the 10-month 124.19, and price below that level would be weak price location. So the pound dollar has been in a weak price location since mid-December below that level, and the support comes in a little lower here on this halfway point off the October low to the December high. It comes in just above 121, so price below 121 would be very weak price location indeed for the pound dollar. That would indicate strength for the dollar. We may see a bounce here, but price back above this level would indicate higher. I have no obvious key levels on the euro FX chart, which are local to current price. We've had a little bit of a rally back here. The current distribution long term suggests a price target down here. So again, I don't see anything on this chart which is clearly negative for the dollar. Okay, all the important levels will be in the ebook released on Monday. Key charts going into next week, I think, being the Russell 2000 ETF IWM and that T-bond ETF TLT, and we'll monitor those levels day to day in the pre-open. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.